Hello students, in present video I am going to explain about second problem from company accounts lesson. I am taking this question from advanced accountancy subject BCom second year semester 3 Pankaj publications book. Let us see the question first. This is a question. Second problem. Mahesh Company Limited issued 5,000 preference shares of 100 rupees each and 5,000 equity shares of 100 rupees each. The shares were payable on application in case of preference share 25 rupees, in case of equity share 20 rupees. On allotment, preference share 20 rupees, equity share 30 rupees. On first call, preference share 30, equity share 20. On final call, preference share 25, equity share 30 rupees. The public applied for 3,000 preference shares and 4,000 equity shares. The directors did not make the final call. All monies called on shares were received except first call money on 200 preference shares and 300 equity shares. Pass journal entries and prepare the opening balance sheet of the company. This is the problem. Let us see the solution for this. Let us understand the meaning of this question. See, there is one public limited company. Company's name Mahesh Company Limited. So their authorized capital is not given in the question. He has started the question directly with the issued capital. So in current year, company wants 10 lakh rupees capital. So for this amount, company wants to sell shares to public. Preference shares, 5,000 company issued. One share face value is 100 rupees. Equity shares, 5,000 shares at the rate of 100 rupees each company issued. So preference share total amount 5 lakh rupees, equity shares total amount 5 lakh rupees. Then two amounts total 10 lakh rupees known as issued capital. The next one is public applied for 3,000 preference shares and 4,000 equity shares. Company issued 5,000 preference shares, but public applied for only 3,000. Similarly, company issued 5,000 equity shares, but public applied for 4,000. Means demand is less than the supply. In case of two shares, preference share and equity share, there is under subscription. Now, subscribed capital total amount is how much? Preference shares, 3,000 shares at the rate of 100 rupees each, 3 lakh. Equity shares, 4,000 shares at the rate of 100 rupees each, 4 lakh. Total 7 lakh rupee. Next, called up capital. So on one preference share, how company wants to color the amount? One preference share face value is 100 rupees. No? Total money company is not going to collect at a time. On installment basis, company wants to collect 4 installments. Application money, allotment money, first call money and final call money. In case of preference share, application money per share is 25 rupees. Allotment money on one share 20 rupees, first call 30, final call 25. Total 100 rupees. Equity shares also same. On installment basis, company wants to collect. One equity share face value is 100 rupees. No? Through applications, company wants to collect 20 out of this 100. Allotment 30 rupees, first call 20, final call 30. Total 100 rupees. And in current year, company made application, allotment and first call. So company didn't call final call money. In next year, company is going to call this amount. So in case of preference share, in current year, how much company called? 100 minus 25 final call money, 75 rupee company called. In case of equity share, 100 minus 30 rupee, 70 rupee company called in current year. Then called up capital is 3,000 shares. Public applied for 3,000 preference shares. No? In case of preference share, 3,000 into 75 rupees. Because company called only 75 rupees. No? 2,25,000. In case of equity share, called up capital is how much? Public applied for 4,000 shares into on one share company called 70 rupees. No? 4,000 into 70 rupees each, 2,80,000 is called up capital in case of equity shares. Then finally come to paid up capital. In case of preference share, called up capital is 2,25,000 no? On 200 shares, company failed to collect this 30 rupees. So 2,000 into 30 rupees each, 6,000 is known as calls in arrears. So from called up capital, when you subtract calls in arrears, then paid up capital comes. So in case of preference share, paid up capital is 2,19,000 rupees. Come to equity shares. Called up capital is 2,80,000. On 300 shares, company failed to collect first call money. So first call money 20 rupees is not coming on 300 shares. Then calls in arrear amount is 300 shares into 20 rupees each, 6,000. Then finally paid up capital is how much? 2,80,000 minus 6,000, 2,74,000. So in case of preference share, paid up capital is 2,19,000. For equity share, paid up capital is 2,74,000. Total paid up capital is 2,19,000 plus 2,74,000, 4,93,000 rupees. So remember, in question, authorized capital is not given. Issued capital is 10 lakh rupees. Subscribed capital is 7 lakh rupees. Called up capital is total of these two amounts, 2,25,000 plus 2,80,000. Total 5,05,000. Next, paid up capital 4,93,000. And in question, he is asking us to write journal entries for all these transactions. And he is asking us to prepare opening balance sheet also. On company's account topic, I made two videos. In first video, I have explained the categories of company share capital. So about authorized capital, issued capital, subscribed, called up and paid up capital in detail I have explained in that video. Next, first problem related video I made. So these two videos links I am giving in the description box. Let us see the journal entries first. First, what happened? Company received application money on preference shares and equity shares. So for this we have to write one entry. See, company Mahesh Limited. So in company's books we are writing journal entries, no? Therefore analyze all the transactions from company's point of view. Applicants applied for 3,000 preference shares and 4,000 equity shares. On one preference share, application money is 25 rupees. On one equity share, application money is 20 rupees. Then how much money company received through preference shares? 3,000 shares into 25 rupees each, 75,000. Equity shares, 4,000 into 20 rupees each, 80,000 rupees. So total 75,000 plus 80,000, 1,55,000 rupees company received from shareholders through application. For this, now we have to write the journal entry. Our assumption is shareholders directly deposited that money into company's bank account. So here company's bank is receiving money from applicants. So bank account is one account, applicant's account is another account. Bank account is a personal account because a particular bank name we have to write here. Means account is opened with one firm name. So with a person name, with a firm name, if you open any account, that is a personal account. Here bank name is not available. For example, State Bank of India account, HDFC bank account. So these are personal accounts now. Therefore personal account rule we have to apply. Personal account rule is debit the receiver, credit the giver. Banker is receiving money, therefore banker is a receiver. So bank account we should debit. In first entry, bank account we have to debit. Bank account debtor 2. Some applicants paid 75,000 rupees on preference shares. Some applicants paid 80,000 rupees on equity shares. So in first problem, he has given only about equity shares. But in second problem, he is giving information about a preference share and equity share both. So while writing the entries, equity share information, preference share information, both we have to show. So while explaining the journal entries, remember one point, that is debtor is an asset. Asset shows a debit balance. Creditor is a liability. Liability shows a credit balance. Debtor means a person who is liable to the firm. He has to pay money to the firm. Creditor means firm is liable to them. We have to pay money to them. Here, applicants are giving money to us. In future, firm has to return that money to applicants now. So for this application money, applicants are creditors. So creditor is a liability and we have to credit. Therefore, applicants' accounts we have to credit. So instead of writing all applicants' names, we will write preference share application account, equity share application account. Therefore, preference share application account, equity share application account. These two are also personal accounts. Because instead of writing applicants' names, we are writing these two words. And these two accounts are to be credited to preference share application account, to equity share application account. Preference share application money 75,000 rupees. Equity share application money 80,000 rupees. Total we have to debit 1,55,000 rupees. So this is the first entry. See, this is journal format. Journal, serial number, particulars, debit, credit. We can ignore LF number column. Date column not necessary because dates are not given in the question. First entry is bank account debtor to preference share application account to equity share application account. Narration. What happens? See, preference shares. Public applied for 3,000 shares. On one share, application money is 25 rupees. So 3,000 into 25 rupees per share, 75,000 rupees on preference share company received. Equity shares, public applied for 4,000 equity shares. On one share, application money is 20 rupees. 4,000 rupees into 20 rupees each, 80,000 rupees company received on equity shares. Mention that in the narration. Being application money on 3,000 preference shares at 25 rupees per share and 4,000 equity shares at 20 rupees per share received. Second entry is for transferring these application amounts to share capital account. Here, preference share application amount we should transfer to preference share capital account. Equity share application amount we should transfer to equity share capital account. Share capital is also a liability because from applicants we are receiving that money. In future, company should return that money to applicants. So share capital liability also shows a credit balance. Therefore, share capital account is to be credited to preference share capital account. Similarly, to equity share capital account. Preference share application money we should transfer to preference share capital account. Therefore, we should debit preference share application account. Similarly, equity share application money we want to transfer to equity share capital account now. Therefore, we have to debit equity share application account. Preference share application amount 75,000 rupees we should transfer to preference share capital account. Equity share application money 80,000 rupees we should transfer to equity share capital account. So why we are debiting these two? Because in first entry by crediting we have created preference share application account, equity share application account. In second entry, these two application accounts we are transferring to their capital accounts. When you transfer like that, these two application accounts will get closed. By crediting we have created them. If you want to close them, you have to debit. Therefore, we are debiting preference share application account and equity share application account. So remember, regarding application, there will be two entries. Received entry, transfer entry. So for receiving the amounts, one entry. For transferring these application amounts to share capital, another entry. So second entry, preference share application account data, equity share application account data to preference share capital account to equity share capital account. So what happened here? Preference share application money 75,000 we have to transfer to preference share capital account. Equity share application money 80,000 we have to transfer to equity share capital account. So mention that in the narration. Being preference share, comma, equity share application amounts transferred to preference share capital account and equity share capital account. Next come to allotment related entries. For application we wrote 2 entries, no? Similarly for allotment also 2 entries. First transfer entry, then received entry. In case of application, first we wrote received entry, then we wrote transfer entry. Because how much we receive, that only we transfer. But for allotment, first call, final call, first we can write transfer entry. Because now we know very well how much money should come. In case of preference share, on 3,000 shares, money should come. In case of equity shares, on 4,000 shares, money should come. Because public applied for 3,000 preference shares and 4,000 equity shares now. Therefore, first transfer entry we will write, then received entry we will write. What is a transfer entry? See, for transferring application money to capital accounts, this is the entry now. In the same manner, now allotment amounts we should transfer to capital accounts. Therefore, preference share allotment account data, equity share allotment account data to preference share allotment money we should transfer to preference share capital. Therefore, credit preference share capital account. Equity share allotment money we should transfer to equity share capital account. Therefore, credit equity share capital account. Amounts. Preferential allotment money how much? Public applied for 3,000 preference shares and the company allotted all those shares to them. On one share, allotment money is 20 rupees now. 3,000 into 20 rupees, 60,000 is the allotment money on preference shares. 60,000 rupees. Equity share allotment money. Public applied for 4,000 equity shares and the company allotted 4,000 shares to them. On one share, allotment money is 30 rupees. So 4,000 shares into 30 rupees each, 1,20,000 is the allotment money on equity shares. Equity share allotment amount is 1,20,000. So 60,000 we should transfer to preference share capital account. 1,20,000 we should transfer to equity share capital account. Why capital accounts are created? Because allotment money we want to transfer to capital accounts. So capital is a liability, no? Liability shows a credit balance. That is why capitals are created. And why allotment accounts are debited? Because we are writing in the books that from applicants we should receive 60,000 and 1,20,000 rupees. So for these two amounts, applicants are debtors to us. Debtor is an asset. Asset shows a debit balance. Therefore, preference share allotment account, equity share allotment account, these two accounts are debited. Actually speaking, here we should debit preference share applicants accounts, equity shares applicants accounts. But the applicants are many. All those names we cannot write. So instead of writing their names, we are writing preference share allotment account, equity share allotment account. So these two accounts are personal accounts. Just like preference share application account, equity share application account. This is the third entry. Preference share allotment account data, equity share allotment account data to preference share capital account to equity share capital account. Narration. So what we are doing here, preference share allotment money 60,000 we are transferring to preference share capital account. Equity share allotment money 1,20,000 we are transferring to equity share capital account. Mention that in the narration. Being preference share, comma, equity share allotment amounts transferred to preference share capital account and equity share capital account. Now come to fourth entry, received amounts. See, there are no calls in arrears. On preference shares, applicants paid total 60,000 rupees. On equity shares, applicants paid total 1,20,000 rupees. Our assumption is these two amounts directly company has deposited in company's bank account. So as per personal account rule, banker is a receiver. Therefore, we should debit bank account debtor to preference share allotment account. In first entry, we have created preference share application account, equity share application account. No? Similarly, in fourth entry, instead of application account, allotment accounts we should credit. Preference share allotment account to equity share allotment account. Amounts, these two amounts, 60,000 for preference share, 1,20,000 for equity share. Total 1,80,000 is deposited into bank account. Therefore, debit bank account with 1,80,000 rupees. Why these two accounts are created? In third entry, we wrote that applicants are debtors for allotment money. Company should receive these amounts from applicants. In fourth entry, we received allotment amounts from them. Now they are not debtors. Means we have to cancel their accounts. By debiting, we have created debtors accounts. If you want to cancel them, you have to credit. That is why preference share allotment account, equity share allotment account we are crediting here. So remember, regarding allotment, there are two entries. Transfer entry, received entry. This is a fourth entry. Bank account debtor to preference share allotment account to equity share allotment account. So for what we are writing this entry? Preference share allotment money 60,000 we received. Equity share allotment money 1,20,000 we received. For that we are writing this entry, mention that in the narration. Being allotment money on 3,000 preference shares at 20 rupees per share and 4,000 equity shares at 30 rupees per share received. Now come to fifth entry. Fifth entry and sixth entry are for first call, third installment amounts. So like allotment, for first call also, first transfer entry will write, then received entry will write. Transfer entry. See, to transfer allotment amounts to capital, this is the entry. No? In the same manner, we have to write first call transfer entries. Preference share, first call account debtor, equity share, first call account debtor. 2. Preference share first call, we should transfer to preference share capital account. Therefore, credit preference share capital account. Equity share first call, we should transfer to equity share capital account. Therefore, credit equity share capital account. And amounts? On 3,000 shares at the rate of 30 rupees each, we should receive first call money on preference shares. Therefore, preference share first call amount is 3,000 shares into 30 rupees each, 90,000. 90,000 debit and 90,000 credit. In case of equity shares, on 4,000 shares at the rate of 20 rupees each, we should receive first call money on equity shares. 4,000 into 20, 80,000 is the first call money on equity shares. Debit 80,000 rupees for equity share first call. That money transferred to equity share capital account. So why capital accounts are created? Because first call money we want to transfer to capital accounts. Share capital is a liability. Liability shows a credit balance. That is why capitals are created. Why first call accounts are debited? Because these two amounts, 90,000 and 80,000, company should receive from applicants. For these two amounts, applicants are debtors because they have to pay to the company. Debtor is an asset. Asset shows a debit balance. That is why applicants accounts we should debit. As we cannot write all those applicants' names instead of writing those names, we wrote these two words: preference share first call account, equity share first call account. Therefore, these two accounts are also personal accounts. Fifth entry, preference share first call account data, equity share first call account data, two preference share capital account, two equity share capital account. So we are writing this entry to transfer first call amounts to capital accounts now. Preference share first call money 90,000, we are transferring to preference share capital. Equity share first call money 80,000, we are transferring to equity share capital. Mention that in the narration. Being preference share, comma, equity share first call amounts transferred to preference share capital account and equity share capital account. Now sixth entry is for receiving first call money. Preference shares. On 3,000 shares at the rate of 30 rupees each, 90,000 should come. But on 200 shares, company failed to collect first call money. Then finally, on 2,800 shares only, first call money came. How much? 2,800 into 30 rupees each, 84,000 rupees. Come to equity shares. On 4,000 shares at the rate of 20 rupees each, 80,000 should come. But on 300 shares, company failed to collect first call money. Then finally, on 3,700 shares only, at the rate of 20 rupees each, company received first call money. 3,700 into 20 rupees each, total 74,000 rupees. So, how much money finally company received? On preference shares 84,000 rupees plus on equity shares 74,000 rupees, total 1,58,000 rupees. Our assumption is applicants directly deposited that money into bank account. So, as per personal account, banker is a receiver now, debit the receiver is applicable. Therefore, bank account we should debit. Bank account data 2. See this entry. Allotment received entry, bank account data to preference share allotment to equity share allotment. In same manner, here for first call also we should write. So instead of preference share allotment, we should credit preference share first call account. Similarly, instead of equity share allotment, we should credit equity share first call account. Preference share first call, 84,000 rupees came. Equity share first call, 74,000 rupees came. For bank, total 1,58,000 rupees. Total of these two amounts. So this is the final entry for receiving first call money. Why first call accounts are created? In fifth entry, we have debited first call accounts because we are writing in the books that for first call amounts, applicants are debtors. From them, we should receive these two amounts. Now, company received the amounts. So, these debtors accounts we have to cancel. By debiting, we have created debtors accounts. If you want to cancel them, you have to credit. That is why preference share first call, equity share first call accounts are created. And why bank account is debited? Already I have explained to you. Banker is a receiver now, therefore bank account is debited. So, finally, for first call, there are two entries, transfer entry and a received entry. Sixth entry, bank account debtor to preference share first call account to equity share first call account. So for what we are writing this entry? For receiving first call amounts. In case of preference share, on 3,000 shares, we have to receive first call amount at the rate of 30 rupees each. But on 200 shares, first call money not came, no? So finally on 2,800 shares only, we received first call money at the rate of 30 rupees each. Similarly, in case of equity shares, on 4,000 shares, we should receive first call money at the rate of 20 rupees each. But on 300 shares, first call money not came. So finally, on 3,700 shares only, first call money came. Mention that in the narration. Being first call money on 2,800 preference shares at 30 rupees per share and 3,700 equity shares at 20 rupees per share received. On preference shares, 84,000 rupees came. On equity shares, 74,000 rupees came. Total 1,58,000 rupees came. Now come to final call. In first problem, for final call also we wrote journal entries. Received entry, transfer entry. But in second problem, we should not write the entries for final call. Because in current year, company made only application money, allotment money and first call. So final call money, company wants to collect in next year. Therefore, final call related entries in next year we have to write, not in present year. Therefore, in journal, up to 6th entry only we should write. So journal is completed. Take a screenshot of journal. Next page. After writing journal entries, he is asking us to prepare opening balance sheet. Let us see how to prepare balance sheet. Balance sheet heading, balance sheet of Mahesh Company Limited as at dash. Because date is not given, we have to write the date here. Liabilities amount, assets amount. First come to liabilities. Under share capital heading, we have to show different categories of liabilities. We have to start with authorized capital. But in present problem, authorized capital information is not given. Directly starting the problem with the issued capital details. Therefore, authorized capital is nil. Come to issued capital. Preference shares, 5,000 shares company issued at the rate of 100 rupees each. So 5,000 into 100, 5 lakh. Equity shares, 5,000 equity shares company issued at the rate of 100 rupees each. 5,000 into 100, 5 lakh. So issued capital for preference share 5 lakh, for equity share 5 lakh. Total issue capital is 10 lakh rupees. But issued capital, subscribed capital, we should not consider for liabilities total. That is why for this 10 lakh rupees, draw 2 lines. Means while calculating total liability side, we are not considering this 10 lakh rupees. Next come to subscribed capital. Company issued 5,000 preference shares, but public applied for 3,000 preference shares. Company issued 5,000 equity shares, but public applied for 4,000 equity shares. So issued capital, subscribed capital are not same. Show subscribed capital separately. 3,000 preference shares at the rate of 100 rupees each. Public subscribed. So 3,000 into 100, 3 lakh is preference share subscribed capital. Equity shares, 4,000 equity shares at the rate of 100 rupees each, public applied. Therefore, equity share subscribed capital is 4,000 shares into 100 rupees each, 4 lakh. So total subscribed capital is 3 lakh plus 4 lakh, 7 lakh. 7 lakh also for totaling purpose we should not consider. Therefore, draw 2 lines. Next come to called up and paid up capital. Authorized capital, issued capital, subscribed capital we have to show separately. But called up and paid up capital combinedly we have to show. Called up and paid up capital. Preference shares. Subscribed preference shares are 3,000. No? One share face value is 100 rupees. But company called only 75 rupees in current year because final call didn't make by the company. Therefore, 3,000 preference shares of 100 rupees each, 75 called up. So 3,000 into 75 rupees per share, 2,25,000 is called up capital in case of preference share. But to show the paid up capital, call scenario we have to subtract from called up capital. In present problem, call scenario is there no? In case of preference shares, on 200 shares, first call money 30 rupee not received. Therefore, minus called scenarios 200 shares into 30 rupees each, 6,000. So called up capital 2,25,000 minus call scenario 6,000. Then finally, in case of preference share, paid up capital is 2,19,000. Come to equity shares. Subscribed equity shares are 4,000 at the rate of 100 rupees each. But in current year, company didn't make final call. Final call money 30 rupee no? Then in 100, if 30 rupees removed, called up money is 70 rupees in current year. Therefore, called up capital is how much? 4,000 equity shares of 100 rupees each, 70 called up. So 4,000 shares into 70 rupees per each, 2,80,000 is a called up capital in case of equity share. To know the paid up capital, calls in arrear we have to subtract from called up capital. In case of equity shares also, calls in arrear is there. On 300 shares, company didn't receive first call money. Therefore, 300 shares into 20 rupees each, 6,000 is the calls in arrear regarding equity shares. So, paid up capital is how much? 2,80,000 called up capital of equity shares minus calls in arrear on equity share 6,000. Finally, in outer column, 2,74,000. So, paid up capital for preference share is 2,19,000. Paid up capital for equity share is 2,74,000. Total 4,93,000. This amount we have to consider for totaling liability side. Now liability side completed. Come to asset side. Finally, how much money company received from applicants? 4,93,000 rupees now. Our assumption is that money is deposited in our bank account. Therefore, asset side cash at bank 4,93,000. Total same. Liability side, asset side, finally totals are same, 4,93,000 rupees. Take a screenshot of balance sheet. So this is the end of second problem. Hope this video is helpful to you. Thank you.